Alright, I'm finally back. Made the move to Malaysia, as you guys can see from this incredible view behind me. Today, I'm going to be posting one of the most powerful videos you could ever watch on technicals. It's going to include every single point on the 5-minute charts and the 30-minute charts you could possibly need to be a profitable trader. If you watch to the end, the only thing you'll have left to do with trading is complete the psychological side. So without further ado, let's get straight into the video. So as you can see on screen right now, this is going to be everything I'm going to touch on in this video. With a simple overall strategy explanation, universal laws for both timeframes like I mentioned. I'll go through each of these points below, plus some extra ones that I just don't have typed on. And at the end I'll cover something very important, which is how to understand and keep the edge of the strategy, now that you actually know the technicals and the ins and outs of how it works. Alright, so hopping into the charts, the first thing I'm going to be going over is of course a quick, simple strategy explanation, so you guys understand what it's about, and you know how to actually apply all the small tips, tricks, all the specific rules we're going to be going over after this. So if you don't know the strategy yet, make sure you pay attention to this part, because this will be the basis of everything we're about to add on to this in the rest of the video. So to start with, liquidity supply or demand is essentially about this drawing I'm about to put on the charts. You have a normal demand zone that's very strong, price will come back down and it won't reach that demand zone, and it will push up and make a new high. Now, what does this leave behind? It leaves behind a demand zone right here and a demand zone right here at the bottom. So the problem is with normal supply and demand is that the markets, they don't exactly have everything they need to push off 100% in a direction, which is of course liquidity, a good price for banks and institutions to fill millions of pounds worth of orders at. This strategy is taking advantage of those two factors in order to have a higher win rate, a better risk to reward, depending on how you trade it. So essentially, if we look right here, the next thing we would expect is price to come down to this zone. Normal supply and demand traders would be getting in. A good thing for us is when there's often a fake out here, so we know they're getting in, and then it goes to our zone. Now these normal supply and demand traders, I used to trade it myself personally. A lot of the times you experience this, price will stop you out by a couple pips, and then it will go in your direction. Now what they don't realize is that is always often because this is actually playing out, this situation. And so the power of this strategy comes from the fact that we're entering off this zone, which always tends to be the bottom of large moves that you see. So essentially, you're catching more of a move from a better place. Normal supply and demand traders, they might catch, let's say, within this push upwards, there was a small little retracement onto the zone. And so they can take a 1-to-1, a 1-to-2, and then quickly snip it off there. But with liquidity supply and demand, you're often getting in from the bottom of the move, you catch the whole thing. And essentially, as you're about to discover in the next half of this video, all the small tips and tricks, small intricate rules that go into it, actually allow you to have a proper playbook, 100% rules, so you know what you're doing all the time, versus just entering because you think a zone's nice or it looks quite nice with normal supply and demand. So that's the basis of this strategy. If you look at the setups on the screen right now even, you can sort of see that playing out. So even with this trade right here, normal demand zone, price comes back, it loses at this zone. Now of course here you can see this candle just straight up invalidated it. In the live markets, there's a very high chance this candle was rejecting the zone, starting to move. People got in, and then it ended up invalidating by a couple pips before winning. And if you look closely, this push to the upside, well, it essentially started exactly from where our entry is. So that's the power with this strategy. Now, let's get into the rest of the video so you can understand how to trade it properly. So first off, I'm going to talk about the universal laws. These are things that apply between both timeframes, the 5-minute and the 30-minute charts. Even if you trade a different time frame, between all of them, these things are going to be the same for each time frame you trade. So the first thing is untapped zones, never close in the zone, and liquidity must take out its own high. So let me jump onto the charts and I'll explain each of these three things. If you want, pause the video, take a quick look at these pictures I've got on screen. They'll also hold a quick explanation. The first universal law was about untapped zones. Now this is a very simple one. If you look at this example right here, no candles have ever come back to the zone. That's exactly what it means. No candles ever come back to the zone after it was formed. Of course, apart from the ones where you'll be entering off. So this one's very simple. You can see it's just clear space, no wicks, nothing in the zone at all. If I move to this next one, it's a bit more complicated. You guys might see this and be thinking, well, there's wicks in the zone right here. Is this not a tap zone? These ones do not count as tapped, and I'll explain why. The candles leaving the zone as part of the demand move, they don't count as tapped as long as they're the same color. So in the case of a demand, the green candles leaving the zone as part of the move, their wicks don't count as making the zone tapped, so that's fine in this case. If, for example, any of these candles were red and the wick had tapped the zone, that will count as a tap zone and it would not be valid, we'd be ignoring it. Of course, if any other candles randomly came back, touched the wicks, like let's say this wick right here, touched this zone, whatever, we wouldn't be trading off that zone anymore because it would be a tap zone. So make sure you take notes of every single one of these things because they all come together overall to make the strategy very powerful. But the next universal law is that liquidity must take out its own high. You can see here I've also added accuracy zones. That's a very important one that we'll touch on afterwards. So what does this actually mean? Well, this one is also quite simple once you get the hang of it, but it's a must for every single trade in this strategy. So liquidity must take out its own high. Of course, as you can see right here, we have the liquidity in front of our zone for the trade. Now, this liquidity right here, this was the high point it made. It has to take out its own high to actually be a valid liquidity. So you can see it came down here, came up, and it took out its own high right here very cleanly. So at this point, we've got an untapped zone, we have liquidity, which took out its own high, and so everything is valid and it's shaping up for a good trade. For a supply zone, it's the exact same, all the rules still apply, it's just the opposite way around. So right here we have a supply zone, is it untapped? Very cleanly. We have multiple liquidities right here, 1 high, 2 high, 3 highs. This one will count as the main one just because it's the closest. Check the rules, okay, this is the liquidity. This is the low point it made before forming the liquidity. Did it take out its own low? Yes, it did right here. So that is now valid liquidity for this zone. Even if we came back earlier, we have this liquidity. Did the liquidity at this arrow, did it take out its own low? Well, let's take a look. This is the low point it formed before forming liquidity. And right here, it took out its low. So if it had done that and come back to the zone right here, it still would have been a valid trade. The fact that it built up more highs of liquidity in front of our zone and still made sure to take out the low each time, that's just an extra confidence to us because there's more liquidity for the markets to move in our direction. Now I'm going to show you an example of the liquidity failing to take out its own high, and avoiding these trades will obviously avoid a lot of the losses that can occur. They're lower probability setups. I'm not saying they'll never win, but you don't want to take ones when this happens. So if I look right here, we have a nice untapped demand zone and we have a potential liquidity right here. So now obviously we need to make sure everything lines up. Did the liquidity take out its own highs? That's the confluence we're looking at with this trade. Well, the liquidity is high here, and no, it didn't. They came to this area and they dropped. So this would have only been valid if this liquidity took out its own high, which would have meant coming up, of course, past this white line. That failed to happen. It only came down to here before coming to the zone. Now this will look like a very good reaction. It's gone green out of the zone, but it's important when this happens, you don't take the trade, you don't get FOMO, and you're actually disciplined to stay out of the markets. Now if I quickly play this forwards, 3 bullish candles and then the trade would have lost. So it's very important to make sure you don't take the trades when they don't line up with every rule in the strategy. Getting back into this, the next point is going to be accuracy zones. Now this is one that's quite complicated, okay, it can take a while to understand. Once you get the hang of it, it's crucial as a part of this strategy, taking the best winning trades and also finding trades that might not be valid without this. So right here I've got a drawing which should help to explain this point. So this is going to be about how you draw the zone using the body or the wick. It's going to depend on a few factors, which is mostly due to the length of the candle and whether it goes higher or lower than the previous candle that's on the zone. So if you look right here, this zone on the left, pretty much I've just copied this, but I've made it so this green candle's bottom wick actually goes lower than the red one afterwards. So when we look at this, right, the normal way of drawing a zone is just to use the whole of the green candle, of course on a supply, the whole of the green candle before the move started, like you can see with this red zone. The accuracy zone way of doing it is to use only the body of the green candle, like you can see on this picture on the right. So why do we do this? This is because the green candle's wick goes lower than the red candle on the supply zone. Now this can be any point, it doesn't matter how the body of the candle looks. All that matters is that on a supply zone, if the green candle before the move that you draw the zone on, if any part of that green candle goes lower of the red candle next to it, then you only draw it using the body like this picture on the right. Now the main point to consider with this is that of course banks, institutions, they are who are moving the market. Now if we take into consideration what I've put on the right with this blue line, that's about a 10 pips different in how you draw the zone and a 10 pips difference in where they might take the sales from that end up moving the market. 10 pips for any banks, consider that they might have billions under management. 10 pips can equal millions of pounds, dollars in potential profit or loss, right? So it's very important to them that they don't take sales from this, for example, which is a lot worse price than it would be taking it from a zone like this. So that's the principle behind it. I'll go onto the chart so I can explain it properly with some live examples. Okay, so looking at this trade right here, we'll walk through all the steps just to make sure we understand the strategy. What do we see? First of all, we have a demand zone. Now this one is drawn normally. You can see I've used the wick on the red candle. Why is this? Well, because no part of this red candle went higher than the green candle after it. That started the demand move. So you just draw it the same as any normal zone using the whole red candle. Now, if I look to this trade up here, this one was actually a loss, but the point still stands. You can see, if we look closely at the zone, this red candle went higher than the green candle that started the demand move. Now, when this happens, accuracy zones come into effect. We only draw it using the red candle's body. So that is how the rule works. I'll quickly find a supply setup just to show this both ways. The supplies, again, this is just a standard one, just to make sure we understand both. The normal zone, you can see, no part of this green candle came lower than the red candle after that started the supply move. So that means we just draw a normal zone using every part of the green candle to the high of the zone. This is a very, very nice example of accuracy zones making you win a trade. This is on EURUSD. If we look in detail at this zone, what can we see? So first off, we have the green candle that you draw the supply zone off. The red candles that started the bearish move. Right, standard supply and demand. Now, if we look at this, the green candle becomes lower than the red candle after it. Very simple when this happens. We're going to only draw the supply zone using the green candle's body and ignore the bottom wick. So for supplies, it's just the same, it's just the other way around. Did any part of the green candle come lower than the red? Demands, did any part of the red candle go higher than the green candles? So I delete this zone and I zoom out a bit. Of course, you can see this is our normal supply zone. The reason the accuracy zone works so well here is because if we drew it the normal way, and used the whole candle like this, as you can see, this zone would not be untapped, right? This green candle right here, it would have tapped it. This green candle would have closed inside the zone, so it would have been invalid for us. And we never would have taken this trade, which you could see was a very big trade, and it hit a very nice TP. Now, of course, accuracy zones. Any part of the green candle, did it come lower than the red one after it? High move? Yes, it did. We used the body only. Look how much this changes. It makes a massive difference. It means the zone was not tapped here, so we didn't enter. I just draw on liquidity for you guys. This one is a one candle liquidity. So essentially, it was faking out this normal supply zone, faking traders out, red candle, rejection, using them as liquidity, and then taking our zone, which is nicely above. If you look at this, it was untapped right here by about 1 or 2 pips. Accuracy zone, very important. It comes right back to the edge of the zone, clearly respects it, and that's how we took our entry. You can see, of course, that one, it had a very nice TP. TP one at the lows, overall TP down here at this high. So that's it for accuracy zones and the universal laws. Make sure you have a very good understanding of these 4 steps, because it's crucial that you have these down. No matter what time frame you trade on, these have to be in place or the trades are not valid. So next, I'm going to be moving on to the 5-minute specific rules. Basically, 5-minute time frame mastery. Entries are very important on a lower time frame because, of course, you have very tight stop losses and a lot can happen. So make sure you, of course, if you're going to trade the 5-minute, have a very good understanding of every step we're about to go over. Okay, the first point we're going to get into for 5-minute charts is just simply the standard entry model. Right here, this trade, in the previous steps, you guys will notice we have a very nice accuracy zone. 2 highs of liquidity right here. This one took out its own lows, this one took out its own lows very nicely. So, standard entry model for 5 minutes is just on the close of the candle. The one thing that's important is that you wait for the close almost every time, apart from a few very specific examples, which I'll get into in a minute. This one right here, tapped into the zone and closed, so there's nothing to explain on this point. You can see simply, the reason we do this is because in backtesting, you always take the close of the candle entries. You never take it while it's rejecting, because of course in backtesting or TradingView, you can't actually see the candles form. Now this is actually a big difference to why people can do so well on TradingView, but in the live markets they can't. And that's because a lot of the time, they'll see a candle like this in live markets, you'll be rejecting the zone a lot, they'll be like, cool, I'm going to get in this trade. And by the time the candle closes, it just closes in the zone or invalidates it, and they're thinking, why did I just take that? In backtesting, this never happens, and this is why a lot of people actually have better results in backtesting. So if you wait for the candle close all the time, you're going to make sure you know what's actually happening. The formation of the candle really doesn't matter at all, apart from in a few very niche examples. I'll get into those in a minute, but for now, the standard entry model for the 5 minute, simple, candle taps the zone, wait for it to close. Does it close respecting the zone? Yes, it did. Take the entry. It's that simple. Alright, our next point is very powerful once you've mastered this, but it'll take a lot of live market experience in order to get this completely right. You have to be very quick when you're doing this in live markets, and also you have to make sure you have experience with candles creating bottom wicks, which I'll also explain. So this is about high time frame flip entries. And this is a very good example right here that I'm going to show it on. If you guys are very switched on right now, you'll realize this is actually the example I had on the first slideshow. This was the one where I had the picture and the arrows right here. So if you realize that, well done, because you're very switched on right now, which is great. So higher time frame flip entries, it is exactly what they say they are, but I'll explain them. When a new higher time frame candle is opening and its bottom wick has tapped the zone in a demand, in a supply, if its top wick taps the zone, and then the candle goes and flips, this is one of those niche times I talked about where you can actually enter without waiting for the candle to close. This is a very good example of why you do that, because otherwise your entry would have been all the way up here, not very good. So let me quickly explain what it means. So if you look at the bottom, this was at 8:30 the candle opens. 30 past is of course a new half an hour candle, a new 30-minute candle. These higher time frame candles, what can they bring? A lot of volume on the open and a lot of momentum. Now if you pair this with the fact that it's also tapping your 5-minute zone, a lot of the time you'll see something exactly like this where the candle just explodes up, and so you don't want to be waiting for the close because you'll often miss out on getting a good entry or even an entry that's valid to take a nice TP. So what do we look for when this happens? Well, as you can see right here, this last candle that tapped the zone, it did actually close respecting. So this might be a normal entry, but one of the points from the list that we're going to go through is when not to enter. 8:25 is actually one of them, 5 minutes before a new half an hour candle. Don't enter them because of course the new half an hour candle with its volume, anything can happen and you can just instantly lose for no reason. So the way to take these sustainably and to use the half an hour to your advantage is, if the candle opens up like you can see and it makes a bottom wick, taps your zone and then comes up and flips, that's when you want to enter flip because momentum will be on your side, it has a bottom wick and it's ready to push upwards. If I quickly go to the 30-minute time frame to explain what I mean by bottom wicks, if you look here, every single candle pretty much, it's very unlikely this doesn't happen. Every single candle has a bottom wick and a top wick in all directions. So this is of course going to need to be formed when the 30-minute candle is opening. Now if I go back to the 5-minute trade we're looking at, taking that into consideration, you're going to want to let the 30-minute make a bottom wick before you enter. Otherwise, if this candle, the new 30-minute opens up, shoots upwards and it has no bottom wick, there's a very high chance it's going to come down and make one, which can of course include coming down and stopping you out of the trade. So you don't want to enter on a new high time frame candle if it doesn't have a wick in the direction you're trading in. Taking that into consideration will cause you to avoid a lot of trades that end up losing, and when it's in your advantage, cause you to get a lot of good entries on trades that have a lot of momentum. When this happens in live markets, you need to be ready because it can happen very quickly due to the momentum. So this candle, green one opens up, bottom wick into the zone, comes up and flips. You have to be ready to enter, ready to have your stop loss under the zone. This is another reason why I say it's very important to have magic keys or any type of lot size calculator if you trade the 5 minutes. Magic keys, link in the description if you guys want to buy it, or code RDFX to get a quick discount on that. This will make it very easy for you to take these entries efficiently. You don't have time to be using a lot size calculator on the 5 minute, especially for flip entries, right? You're just going to miss the trade. You're going to be in somewhere up here after calculating your lots. Like I said, this is going to take live market experience to get these down correctly. You're going to have to take a lot of them all the time. If you're very hesitant with your trades, it's going to be difficult to master these. So if you are that type of person, potentially take it on demo before you go in the live markets, flip entries. The stop loss on a flip entry goes directly under the candle because with the momentum, you expect it to just push straight up and never actually come back down to the zone. That's what happens most of the time. It's a bit more risky. Some people might like to still use the 1 pip stop loss, which I'll get into when I talk about stop loss placement. But simply on flip entries, the candle, the stop loss even just goes right under the candle. So taking this into consideration, you can start to see how all of these points, they merge together very powerfully to create a strategy with an efficient edge. You actually know what trades you're taking and not taking, and you know how to actually trade them. Versus, of course, having a strategy where the rules aren't very clear. You just sort of enter if you think it's a good zone or not. The target is sort of up to you. It's not that clear on the target. 1-to-1s, 1-to-2s. So you don't actually take advantage of where the markets have to move to and all the momentum. You can see right here, this one was about a 1-to-7. With TP rules, it would have been 1-to-5. I'll get into TP rules in a moment. It's the very easy way to take a good risk to reward on all trades if you don't actually know exactly where to place the TP. So our next point is that on the 5 minute charts, you don't have to follow the higher time frame trend, or the overall trend to be exact. The reason for this is that a lot of people get caught up 4-hour daily charts when taking their 5 minute trades, and they're simply aiming for a 1-to-2 and a 1-to-3. The 4 hour, the daily, the 1 hour, these are not important when you're aiming for, let's say, 12 pips, 15 pips on your TP for your 5-minute trade. These are not as important. I'll show you why if I go to the charts and I look on the higher time frame. Here you can see this 4 hour charts. I'll explain what I mean. So if I look at any of these candles, of course you can see almost all of them, they have a bottom wick and a top wick. Now whatever you identify the trend as on the 4 hour charts, you might say, look, here the 4 hour charts are bullish, so you're not going to take any supplies on the 5-minute. The problem with that is, if I zoom in on any of these candles, let's say this one for example, and I measure the size of its wick. This one right here is 10.8 pips. Let's say you're aiming for a 1 to 2, you can easily hit that on the 5-minute charts in 11 pips. Any of these right here, if I measure them, 22 pips, that's more than enough for you to hit a 5-minute TP. So the point with this is that checking the higher time frames, trying to figure out the trend in detail, does not actually help with your 5-minute trades. All it does is cause you to find reasons to actually not take trades that end up winning and just overall miss out on good opportunities. If I even go to the 1 hour charts, any of these wicks, right, you can simply just be forming a wick on the 1 hour time frame, which will hit your 5-minute TP. So let's say you have a 5-minute supply shaping up right now, go onto the 1 hour right here and you're looking and you're thinking, okay, this is very bullish. So it's this candle right here and you're saying, I'm not going to take any supplies just because of how the 1 hour looks. If I play out the next candle, you can actually see this 1 hour, it forms a nice bottom wick, about 12 pips again, and then it did go bullish, so you would have been right. Let's say you had a supply right here and you didn't take it for that reason, you would have just missed out on a winning trade, even though it could simply make the 1 hour bottom wick and then still continue with the higher time frame trend. The 5-minute trades are not very important for the overall trend. Okay, stop loss and TP rules. Right here I have a very powerful tool that will help you with placing your stop loss TPs. So take a screenshot of this, write down these rules for yourself. This is how I trade the 5-minute with my TP placement and risk to reward actual targets. Stop loss based rules is how we decide what risk to reward targeting, just based on how much the average setup likes to move, and just so you can have the good balance between win rate and risk to reward. The rules are all based off stop loss size, so if I was going to take this trade right here, it'd be very simple. We wait for the candle to close. Has it closed respecting? Yes, so we enter on the close like so. Now on a standard entry, which is just the candle closing rejecting, the stop loss goes 1 pip above the high. So I'll measure that out and it's at about 3.2. That's exactly 1 pip above the high for the close. And I'll pull up the rules and just check the distance. So this stop loss is 6.3 pips. 6.3 means that we'll target a 1 to 2 on the trade. So I set this as a 1 to 2 right here and you can see very simply, pretty much instantly hit TP and the trade was never even in drawdown. Now how I used to trade the 5-minute was with what's called double TPs. So it's essentially the exact same rules, but you just double the TP distance. So for any stop loss, when it lines up for a 1 to 2, I would actually just target a 1 to 4. It's the same for all of them. If it lines up for a 1 to 3, I target a 1 to 6. If we line up for a 1 to 5, I'll be targeting 1 to 10. So the only other thing to touch on here about these rules is you can see at the top it says minimum 2 candles closing the opposite direction to create a valid liquidity. So this means that the liquidity, which you can see right here, it has to be at least 2 candles. Opposite direction simply means just red, of course. On a demand zone, the liquidity can only be created really by red candles and lows that you can see. If I put the markets in replay, you can see at this point we have a demand zone and we might be thinking, okay, there's liquidity in front of this demand zone right here, so this is valid. But if we actually check the rules, it has to be at least 2 candles closing in the opposite direction to be valid. So right here we would need 2 red candles, which would create more of a low and actual liquidity in front of the zone, and that would make it valid liquidity. Now 1 candle liquidity zones, they do hit sometimes, but it's just one of those things that makes it a lower win rate if you do decide to take them, and sort of makes the strategy just have a worse edge. Now at this point, it's not really liquidity supply and demand anymore. You can't really consider this liquidity that much, unless it was just to create a very obvious demand zone in front of the zone. For example, it would have to be a little bit closer and a bit smaller to be an obvious zone. For normal supply and demand traders, then be faked out. But 1 candle, like I mentioned, it's more or less just a normal supply and demand trade, and you can't really call this liquidity. Lastly, we have the break-even rules. This is actually entirely up to the individual trader if they want to use them or not. Personally, I never really used to go to break-even. I'm just one who likes to let the trade completely run out. A lot of the time, you'll see it actually comes back and retests the zone. As these zones are so strong, right, they've already got liquidity, they're untapped, all these things adding up. A lot of the times they end up retesting the zone and still winning, which is why I never like to go to break even. This is entirely up to the trader. Perhaps if you're in drawdown something, you might want to use the break even rules just to make sure you protect your capital completely. Entirely up to the individual though if you use them or not. So that's it for stop loss and TP rules. Standard entries right on candle close. It goes 1 pip above or below the candle stop loss. TP rules, you follow that quick rule sheet that I popped up on the screen. For flip entries, it goes directly above or below the candle because we expect momentum to push the trade up or down and not come back to the zone. So that covers that. The next point is 1 trade per day until this got written down. So let me actually explain what this is, and it's quite important. I recommend that you only take 1 trade per day until, let's say it's been a month, 2 months, and you're 100% okay with losing. The actual rule is that you're allowed to take 2 trades per day, and the second trade, let's say you had a loser as your first, the second trade would be with 0.5% risk, just so you're conserving your capital. Now the reason I recommend this is because if you're taking 2 trades per day right from the start, we often tell ourselves we're okay with losing, but if our first trade loses, you'll find that you always somehow manage to find a second trade in the market, often just due to the bias and the fact that you want to make back money. We don't catch ourselves doing this, and so with the 2 trade per day rule, we actually never end up being able to accept losses properly. With 1 trade per day, and you do this for 1 or 2 months, you accept losses. If you only take 1 trade per day, you're never going to have any sort of revenge trade, even if it's disguised as the fact, yeah, this is my second trade, I'm just allowed to do this. You'll 100% be okay with losing. And then that's when you can add in this 2 trades per day rule. The other benefit to this is that you're going to be able to accurately visualize and see the edge playing out over time. This is very important for beginners. You're going to be able to see each individual trade and how exactly it affects your equity curve. If you're taking 2 trades every single day, it's going to be a lot more difficult to see this and how every individual trade and decision you make impacts your equity over time. So that's another reason that I recommend this, especially if you're just starting out with a strategy. And so for the next point, avoid entering at these times. This one I already touched on a little bit. I'll go into more detail. So I said never enter 5 minutes before a new 30-minute candle, because the volume of a new high time frame candle opening can pretty much make anything happen. The same thing applies for a new 1 hour candle. In this case, it's 10 minutes before a new 1 hour candle opens, 5 minutes before a new 30-minute candle opens. So the only time you're allowed to break this rule, the only exception to this, is when a candle flips and closes very far in the opposite direction, which gives the higher time frame candle more than enough space to create its top wick without stopping you out. Now, if you look at this candle right here, this was 10:25 candle, which means a new half an hour is opening on the next one. So in all cases, we would actually not enter on this candle, but right here, you can see it flipped and closed very bearish, which gave us enough space for the new 30-minute to make its top wick if it wants to without stopping us out. Now, this is still very risky, and I would still recommend not even doing it. Let's say you're up a large amount on the month and you can afford to be a little bit more risky with your trades, then you can do something like this. But if you look close, you'll actually still see the new 30-minute candle still wanted to make its top wick retesting the zone before going bearish, and it was very close right here to stopping us out. If you still waited for the new 30-minute candle and you didn't enter on this 10:25, what would have happened? Well, the new 30-minute would have retested the zone, and you actually would have had a better entry right here. So it's all down to the individual trader, how much experience you have with the strategy. Let me quickly find a new 1 hour candle just to demonstrate this more clearly. So if I hover the crosshair right here, you guys have been paying a lot of attention earlier, we'll be able to see why we actually took the entry. If you look, it's because it says it's 9 AM, which means this was a new 1 hour candle. It made its bottom wick into the zone very nicely and flipped, so we can expect a lot of momentum to the upside, and that gives us the potential to take a higher time frame flip entry. The stop loss goes just right under the candle when it's a high time frame flip entry, and in this case it didn't actually make too much difference. The close entry would have still been here anyway. We took off with a lot of volume, however it wanted to retest the zone to collect more orders. Most people, imagine they saw this red candle live in the trade, they'd be extremely nervous. Maybe they close the trade out and they wouldn't be waiting. It's a lot of momentum to the downside. You can see the zones are so powerful it still holds, and it just simply is a retest of the zone, fill more orders, and it explodes upwards. This of course is using double TP rules. 6.3 means a 1 to 2 risk to reward for your TP. Double TP right here, 1 to 4, and it hits very cleanly. Now I don't actually have invalid trades marked onto these charts. If you guys are doing your own backtests of the strategy, you'll see this rule is a game changer. You avoid so many losses where a 10.25 or let's say an 11.50 candle would have closed nicely rejecting the zone for an entry, and by the time the new half an hour opens or a new 1 hour opens, it just explodes and stops you out. So it's very important that you're aware of this, and this is another reason a lot of people lose trades on the 5-minute with time. It's because they're not actually aware of the high time frame candles and when they're opening or closing. So that covers everything for the 5-minute specific rules. If you guys haven't heard any of these before and you find them really helpful in your backtesting in the live markets, be sure to comment them down below, because a lot of these are definitely a game changer for 5-minute win rate, as well as risk to reward with the stop loss, TP rules, etc. The last one down here you can see was break even, which I pretty much already covered. So that's it for 5-minute specific rules. Be sure to go and test this in backtesting and just look what it does to your win rate and risk to reward, right? All these rules, definitely, they're a game changer. Quick side note before we get into the 30-minute rules, if you guys are looking for the best place to learn a strategy, I definitely recommend checking out the link in the description for the Discord. In here, we're doing a lot of things currently, posting weekly webinars, I'm posting daily forecasts, as you can see right here. Basically just analysing all the pairs for the current day. The webinars that I'm posting, they're some of the most powerful tools you can actually watch to improve your trading. Feedback I get from them is amazing. I usually go into 2 or 3 topics in every single webinar, which have changed people's mindsets completely, made them realise about trading seriously instead of trading almost as a game. Of course, also I've got the signal section in here, so putting out all the trades that I take, as well as their analysis once they've been completed. And most importantly, if you trade this strategy, you'll be in here with the community of everyone else who trades it. There's a couple people in here who have pretty much got the strategy down to a T right now. So ask questions, anyone will answer, and you'll find out how to master the strategy on a different level to what you would get just from watching YouTube videos. So next up, I'm going to be jumping into 30-minute specific rules for all you higher time frame traders who are watching this. I myself only trade the 30-minute charts now. I used to, of course, trade the 5 minutes full time. This was just to have more sustainability and less time at the markets. Of course, with the 30-minute charts, I'm able to be away from the charts a lot more often. It's only one candle forming every half an hour, and actually have freedom, more free time, which is of course why most of us started trading in the first place. Okay, for the first 30-minute rule, this is probably actually the most important one, so pay a lot of attention. If you can't see what's about to happen on the charts right now, you're most likely a beginner trader. Let me play this out so you can see what's about to happen. Whenever this picture appears on your chart, make sure you're ready for buys. As soon as you see, like right now, price is currently reacting off the sunglasses, make sure you're getting ready because it's about to explode up 200 pips. Actual first 30-minute rule is going to be about waiting for directional candle close before entering. So this is essentially just the entry model and what we actually look for once it's reached our zone. So quite self-explanatory for this one. Essentially, you're waiting for the candle that is going in the direction you want the trade to go. As soon as one closes in that direction, that's when we take the entry. So in this example, this candle tapped our zone and closed rejecting. Unlike the 5-minute, we're actually waiting for a candle to close red in the case of supplies, and that's when we'll enter the trade. If it was demands, it'll be the first candle to close green after tapping the zone. Now that doesn't have to be the second candle. In this case, you can see the first candle to tap the zone actually closed green. That's also fine right there. In case you guys are wondering why the sell's valid, liquidity right here just took out this high by a few pips. That's also okay. It doesn't have to be a clear break of structure. It just has to take out the high by at least a couple pips. So the next 30-minute rule is that the trades, they must always follow the overall trend. Now, how I identify trend, I won't go over completely in this video, because that'll be a whole other topic in itself. Could take 20 minutes to half an hour. If you want to find out, in the Discord, lots of webinars where I've covered this, and also just the overall daily forecast, you'll see how I actually analyze the trend. So for a quick explanation of the 2 main points in the overall trend, what I'm looking for is essentially higher highs and higher lows, very simple market structure, and one of the main points people often forget is looking to the left to see where price is reacting from when it's doing certain things. So let's say, for example, we have this double bottom right here. By itself, that's not exactly enough to say that we're bullish, but the main thing I'm looking for is looking to the left and actually seeing where are we reacting from. If we do that here, you can see it's exactly off the bottom of this red wick. We formed the double bottom. As soon as that happened, we had buys on the table, and you can see that actually led us to taking this demand trade right here. So always being in trend is important for the 30-minute because it allows you to target TPs that we actually take. So max stop loss distance and where to place TP1. So the max stop loss distance for the 30-minute time frame is around 30 pips. Now, show you a few examples. If under the candle stop loss placement happens to be, let's say, 31, 32 pips, then of course you can still take that. But if you get a bigger stop loss, let's say 40 pips, we actually limit the stop loss to 30 instead of placing it under the candle. So like you can see in this example here, we actually use the max 30 pip stop loss rule. Now, the good thing about this is that if the stop loss has to be maximum of 30 pips, that will of course indicate that there was a very big reaction and price is already quite far away from the zone. So when it's had an extremely strong reaction like that, you can expect that it's not going to come that far into drawdown anyway to actually tag you out with a 30 pip stop loss. In this case, of course, you can see that here. Our first candle rejected the zone. We enter on the second one to close green. The reason behind that, of course, a lot of candles that just close respecting the zone, if you enter off that on the 30-minute, you find you actually take a lot of trades that just end up losing. So waiting for the green candle close or red candle close on a supply is very important to the 30-minute time frame. So you can see the green candle took off and it was very far away, so we could limit our stop loss to 30 pips. This just allows us to still play it relatively safe with the distance, but actually target a good risk to reward. If I put it under the candle, it would have been around 40 pips, of course having a large effect on the risk to reward. Now in this case right here to the left, you can see I have a 34 pip stop loss. Now the reason for this, you can see we entered off this green candle, and if I use the 30 pip stop loss rule, stop loss will be around here, which is okay, but underneath the candle is so close by, it's not actually worth it. Safely just put it under the candle, it's only a couple pips difference. The rule is really just for in situations where the stop loss would be very large. For example, with news entries, it could be up to 50 or 60 pips sometimes. So 30 pips is the max distance that we place it at. Where to place TP1 ties in perfectly with the last point. Due to the fact that we're trading in trend only, that means we can target the most recent high or low for our TP1. This is what allows us, of course, to have high risk to reward ratios. Right here, you can see targeting the most recent low, that's the 16.5. If I move on to the next trade up here, targeting the most recent low again, this one was about 1 to 6. And so that allows us just to have a high risk to reward. Now the minimum risk to reward for this strategy is a 1 to 3. You can see right here, it's a little bit above the high. I don't take anything less than a 1 to 3. And if you look at this setup, it very nicely uses a small tip I'll let you guys in on. If the candle that closes rejecting the zone, of course, is not green in this case, so we wouldn't enter, closes rejecting, so you're waiting for the next one. If the next candle actually taps, it makes its bottom wick into the zone and then closes green, instead of having a stop loss underneath the first one to tap, you can actually have it underneath the green candle as long as its bottom wick also tested the zone. This is just another one of those small rules that you might not know about, and this allows you, of course, to easily have a better risk to reward. If the candle's already retested the zone once and it does it a second time and closes green, you can expect that it definitely won't have to come back again before it takes off. And you can see that playing out very nicely here. So when to have a TP2. Now you can see on this first trade right here, there was no TP2, and on this second one, you can see there was. Now on this one, I used the Fibonacci trend tool to decide where to actually take it. That's something I'll get into in a later point. Now the reason I actually took one on this second trade was just due to how the market was moving and actually reading price action. For this first one, you can see it was a big push upwards. We simply came back down underneath this first low, tapped into the zone. But for the second trade, before we actually got our entry, you can see there was a lot of consolidation, 2 taps on this low, a lot of consolidation here, a small push upwards, and then it came back to our zone, taking out the original demand / 2 lows right here for liquidity. Now, due to the fact of all this consolidation, we built up a lot of orders, and you can expect us to take off with lots of momentum and continue up past this high. So due to that factor, on this trade, I decided to take a second TP. Now, there's a few scenarios where you actually can decide to take TP2 and not just a TP1. This is a good example of when I might take one. Let's say, for example, I had a short from right here, and my original TP1 is at this low. On this trade, if there was a supply right here, this is a trade that I'll be taking a TP2 on, due to the fact that we have all this movement to correct, we have these gaps to correct, and this clean movement to the downside on the left. With this in mind, I'll be taking TP1 at the lows, that's standard, and I'll be having a TP2 at the bottom somewhere down here. So a good tip I'd add on to this is to actually be okay with just having one TP. You don't have to always aim for those big trades, although they might feel nicer or look better. It's the small, consistent wins over time that's going to make the biggest difference. Big trades can be nice to hit because they'll build up a very big buffer, but it's just these small, simple wins, 3%, 5%. Hitting these consistently, they're the ones that are going to make it very good, profitable equity curve. And it's going to make it easier on your psychology, rather than always just going for massive TPs and not getting as much wins and having more losses. So when to go to break even? Well, I always go to break even after TP1 hits, just because I've already locked in profit. Now I'm just conserving capital. There's no reason to still have risk on the table once you've hit TP1. The only other time I go to break even before the trade is fully played out is if we went extremely close to TP and then we reversed. Now the reason I don't go to break even is because, like I mentioned in the 5-minute section, these zones are very strong, and once they've already had a good reaction, they like to hold if they ever retest the zone. So if I was going to break even in these cases, a lot of the times I'd be break even for no reason. It would simply just retest the zone to build up orders and then push up and hit TP. Now this is not the same with every strategy. In a lot, it can actually be better to go to break even once your trade's taken off, because let's say they're not trading off zones such as we are, strong zones that can retest and still hold. They might be trading strategies where there's nothing to really retest or fill more orders off of. So in our case, not going to break even over a long period of time. Obviously you have to get backtested results, forward test results to actually find this out. Over a long period of time, it's much better for your profitability and it will give you higher returns in the long run. So Fibonacci trend tool, when do you use this? What is it and how do you use it? So this is something that can be used whenever you're taking a TP2, and I'll quickly draw it up on the charts to show you how you actually set this up. So it's this tool right here. It's called trend-based fib extension. And what you want to do is simply, first off, if it's a demand, take it from the low point before it actually created the high that came to your zone. And then after the high, just draw it down to the bottom of the candle that tapped your zone. So essentially, it's just following the trends. It'll be low, higher high, lower low, and then you're expecting, of course, to take off in your direction. So this Fibonacci trend tool, based on the distances from the low to the high and the retracement, will essentially calculate where price can move to comfortably. Now there's two options you can have. Number one, and this one right here. If I quickly open my settings from the tool, you'll be able to see the ones that I have marked on. It's simply just the 1 and the 1.618 levels. These are the two that I use. You can use the first one just for if you're being more conservative. The second one is, of course, if you're being a bit more aggressive, or there's lots of momentum, for example. So that's how I use the Fibonacci trend tool. It can be very powerful for deciding when to take TP. When, for example, there's nothing to the left but clear space for you to base your TP2 off of. This is a good way that I like to use to actually decide where to set that. Quickly show an example for a supply zone so you guys know how to draw it up 100%. I'll use this one right here. The supplies, it's the same, just the other way around. I want to find the low, of course, that I created before coming to your zone, and the high that took it to that low area. So draw it from the high, swing low, all the way up to the point it retraced to, where it tapped the zone. Simple market structure is from the high to the low to the lower high, and then you're expecting it to take off. So it will calculate the distances based on those retracements. And if you look right here, I just targeted simply the first level. The second level here would have actually played out as well. It was quite far away and I was more than happy with the risk to reward on this trade. Avoid entering at these times. For the 30-minute charts, these ones, they're just pretty much common sense, right? If red folder news that's high impact is about to drop, you should probably avoid entering right then. Late on a Friday night, of course before swap hours, I'd recommend definitely not taking supplies because of the spreads, obviously the direction that they open in. Demands, however, you can potentially take them. Of course, it's still high risk, but if you're confident that the trade could take off and give it enough distance for the swap hours and for the markets to potentially drop without actually stopping you out, or even for the next weekly candle to open and form its bottom wick without stopping you out. If you're confident in those two things, then I often say taking demands relatively late on a Friday is actually okay. Potentially just consider using half risk on any of these trades if you do still want to take them. Coming into the last point for the 30-minute charts, if you have multiple zones, which one should you choose? So in a scenario like this, we can see on EU, there was 3 zones. Now the one I'm least likely to consider is normally the middle zone, and I'll explain why. The first zone is okay. This is of course the first zone we can react off. Simply we can come back to it and we can drop. The middle zone, if we end up coming back to this zone, it's the one I'm least likely to take, although of course it will depend on the reaction. I'll be more patient on it and perhaps more conservative on risk if we do end up reacting from one of these. Now the reason for that is because the top zone is of course the best price for institutions to sell from. Now if they're already invalidating zones and not selling from them, then there's a high chance that they'll also invalidate the middle zone to end up going to the best price at the top. That's the reason I'm least likely to take ones in the middle. Of course, if they have an extremely good reaction still, I'll still consider taking them. But overall, if we're invalidating zones, you can expect us to be heading to the top one, best price for institutions, and probably the highest chance that will hit. The top zone will of course be the original area the selling started happening from, so they're not going to want to sell from a worse price if they're invalidating zones. Our price might just be so bearish that the first zone it comes back to, this often happens, it will just drop from that one. That's completely fine. However, if there's one in the middle, even more so. This one is not too bad, but let's say the middle zone was very close to the top one like this, then there'll be almost no chance I'll be taking the middle one, because the top one's right here. There's no reason to take the sells from here, When the best price is just a couple pips above, it's a lot easier for price to reach that area. So that concludes the 30-minute rules. Hopefully you guys took a lot of information from that. Even if you don't trade this strategy, these are universal laws that can be applied to many different strategies. You can take certain parts that you might want to implement yourself. Now let's move on to how to understand and keep your edge. Now this will be one of the most crucial things to understand. I'm going to dive into a lot of detail for this part. Firstly, I just want to bring your attention to this picture that I have up on the right of the screen. A lot of people actually forget this. If you're taking trades with a 1 to 5 risk reward, you only need a 20% win rate to be profitable. So with that in mind, actually consider it's not as difficult as you make it out to be a profitable trader. It all just comes down to the patience and the psychology at the end of the day. Technicals, that's not the hard part. Backtesting. When you're backtesting, the main things to consider are the time differences from the trades you take on there, your expectations for real life. So what you want to be doing when you're backtesting is recording things such as the exact time and the date of the trades, and mark these all down on a spreadsheet so you can actually see the average time between trades so you know what to expect in the live markets. Most people backtesting, they'll have a setup that forms maybe every 1-2 minutes of data they go through, and this can really mess up their psychology in the live markets, because that 1 or 2 minutes might equate to 5 or 6 days in the live markets with no trade. Can you actually handle that? Don't let backtesting misconstrue your perception or how you're going to be taking trades. Forward testing, this is also very important. Let's say you're going to be adding another pair to your strategy. You want to take it on some forward tests first to actually make sure that it trades how you think it will just from backtesting. There can be some differences in the live markets. Journaling, this is very important to understand and keep your edge. Like I mentioned during the 5-minute section about taking only 1 trade per day until this, journaling is very important. It ties into actually you seeing on your equity curve the effect every single trade you take has on your equity curve. If you take trades you shouldn't take, you're obviously also going to see the results and be able to actually visualize it with the charts that they have on journaling platforms. Now, I recommend TradeZeller. It has every single stat you could ever need. You might find out things such as strategy doesn't work well on a Friday just because of the swap hours coming into play. And so you might decide, I'm not going to trade Fridays based on what you see in your stats. Now, consistency. This is the mindset that you have to be in as a trader. You need to be not just consistent in the markets, but in your day-to-day life. It's very important that you have a consistent routine. If you can't be consistent in the things you're doing day to day, it's going to be almost impossible for you to be consistent in the markets. Most of this is, of course, just due to psychology, actually staying grounded in your emotional state, because trading can be very difficult to handle in that sense. This next point, long-term. Having a long-term mindset is something most traders do not have, and they don't even fully understand what it means. The current traders on YouTube, most of them do not preach anything to do with long-term. It's just only to do with how to win right now, in the moment, how to have this strategy. But it's not actually set up with any information towards trading full-time, because that's a lot different. It's just having a strategy, understanding supply demand, and randomly trading off it. Trading long-term, you have to be in an investor mindset. This also ties into the next point. Don't get caught up with the social media mindset. What I mean by this is the social media mindset portrays it as having sniper entries and being cold with trades. Whereas the real mindset, if you want to be a full-time trader, it's nothing to do with this. It's about consistently following your plan, having the investor mindset, right? You have a business, you have a job, you are a capital manager, equity manager. Your job is to be serious, to conserve capital, to trade with your risk parameters properly. If you're, let's say, stuck in a mindset of over-risking, well, you're never going to be able to trade full-time with this mindset. It's not professional and it's not sustainable. If you have 100K and you've built up the account, and you over-risk and lose it all, well, guess what? You can't trade full-time anymore. You have to go back to a job. So that's why it ties in with consistency. If you're not consistent in your day-to-day life and routine, then you won't be able to be consistent with your trading and trade full-time. All these points tie together. Overall, what you see on social media is just really an unserious view of trading. It's treating it like a game, it's treating it like a joke, and it's just making it out as if the technicals are the only important part. What can you read off the charts, when really the technicals are only about 5% of what actually goes into trading. It's what you do outside the charts, your entire lifestyle, all these choices, how disciplined you are outside the markets. Discipline inside the markets is 100 times more difficult than it is outside the markets in real life. So if you can't be disciplined in real life 100%, there's no chance you're going to be disciplined in the Forex markets. The psychological pull you have, the potential with just the click of a buy or sell button, if you over leverage to make thousands in one trade. The potential is there, and so it's always going to be a pull. If you're not a disciplined individual, then you're going to act upon this urge to over risk, to over leverage, to revenge trade when you're down in profits. As long as you understand your edge, you backtest, you forward test, you review your stats, you take 1 or 2 trades per day, you're actually going to be able to have an understanding of your edge. When I used to be in an over trading mindset and I couldn't take 1, 2 trades per day, I didn't have an edge and there was no way of me understanding it. I couldn't even remember all the trades I took last week because there were so many random positions that shouldn't have even existed. All these steps, they all tie together very importantly. Before signing off on this video, this has been quite the long one, probably the longest video I've made so far. If you guys watched to the end, comment your key takeaway, the best bit of information you learned in the comments below. The last thing to sign off with is this amazing, we're getting to sunset, this view right now. Hopefully that is inspirational for some of you guys and you can see what's really possible if you're disciplined with Forex. That's going to be it for the end of this video. Hope you guys took a lot of value from this. I'll see you in the next one.